So I want to pivot a little bit, and we were talking about this last week after we recorded, and we realized that we had never really talked about like the details and the process behind what you call raising cash. So essentially, increasing your cash position in your portfolio, uh, kind of anticipating when you're going to buy on a down day, right? So I want to, and I think many of our listeners would also love it if you could just give us an overview of kind of how you go about that. How you initiate that is probably the biggest question mark, and then of course how you start to trim down your cash position when the time comes.
Yeah, I mean, it's okay. So some people think there are multiple ways to look at this. Well, some people think, okay, you know what, I'm going to run fully invested. I'm just going to be flat out fully invested. I'm invested for the long term. I'm just going to put money to work as soon as I have it. In my personal investing, I don't do that. I will do that if we are in a early stage trend. Um, if, for example, okay, so let's just go back in time for a second. We'll go the Wayback Machine to January and February of 2020, when we started to get a very elevated reading on the percentage of stocks that were trading 5% or more above the 200-day moving average, which is that overbought, oversold indicator that every once in a while we'll share with our subscribers in the service link below. And yeah, and that got up to about, I think it was around 55%, which at the time was pretty extreme reading for us. And that prompted me to get a little bit cautious and start thinking on a macro level that we might be getting a little bit overextended, and that the easy money may have been made. And maybe it makes some sense just to put a little cash in my pocket and rein in some of my exposure to be able to take advantage of maybe stocks going on sale soon. And sure enough, we did indeed get that, obviously, peaking out in February. I looked stupid for having cash for a few weeks up until that peak. And then we rolled down into March, and I was deploying cash within those first few weeks of March. And then as we put in the bottom in mid-March and started to rally, I was mostly back invested. I think I probably had about 5 or 10% that was still kicking around in cash that I then committed back in. And that being then the early stage and that liftoff of our overbought indicator going from 55% more than 5% above the 200-day moving average to like it was a single digit reading, Joe. I don't know if we got down below 10% on that reading, which is a very actionable buy point. So at that point, I would say to myself, well, there's really not a lot of reason for me to be cute here with cash. I'm back in its early cycle. We're starting to move up. At the time, we were just finding out exactly how much the Fed and the Treasury were going to throw at the marketplace to keep the financial markets running rather than getting locked up. So you could run full cash now for a while. Fast forward, and that reading that we were talking about, that overbought reading, starts to get elevated again, goes up to the 55%, got up to 60%, started making me nervous again, take a little bit of cash back in. We pulled back a little bit, then we went again. We didn't pull back nearly as much. And I think that, you and I had mentioned on the show a couple of weeks ago that we were flirting with 80%, which is just a crazy, crazy number. And that made me very nervous. And that, again, start to raise cash. So the question then becomes, okay, when you're starting to raise cash, Todd, how are you doing that? And there's a couple different ways that you can raise cash. You can, I think that one good way to do it, I mean, everybody should go into every trade that they do with a thesis and a catalyst and, an uncle point. So if you're wrong on your timing and you violate your uncle point, and for me, I really don't, I like being right pretty much right away. And if I'm not right pretty much right away, when I get down more than 10%, I start getting nervous. So maybe your uncle point is a loss of 10%. And you say to yourself, you know what? The stock broke down. I was wrong in my timing. I'm down 10%. I'm going to eliminate that one from the holding. So maybe you're raising cash that way, right? You can also take the approach of saying, you know what? I'm going to create an A through F or a 1 through 5, some sort of a ranking system for conviction. and look at the holdings in your portfolio and say, okay, well, maybe I'm putting an Amazon in a one, and a one to me is a never sell. I'm just going to hold it forever, and I don't really care where it is. I'm not caring about it technically. I don't care about anything. I'm just going to hold it forever. So maybe that's a one. But then you look at something else, like maybe you got into one of the SPAC stocks because other people were talking about it, and it moved up a lot, but it's really not a very high conviction trade for you. You were just kind of riding other people's coattails, or you were, maybe this is an interesting stock, but it's not a never, it's a lot of never sell. So maybe that would be on the lower end. So if you were doing a 1 through 5 or an A through F, it would be a 5 or an F. And those would be the ones, after you've done that to all the stocks in your portfolio, those would be your first source of cash. So you'd say, you know what? I'm just going to cut bait on those. I'm going to get rid of those. I don't really know the story or understand the story well enough. I'm going to admit that to myself. I'm going to accept that I either made a little money or I lost a little money, but I really kind of reacted to the stories of the day rather than being proactive and searching out the best companies that I want to own. So that's another source of cash, Joe. And then I would say that the final source of cash for me when I'm trying to raise cash would be to look at stocks that have made me a lot of money, but maybe those have grown to a percentage of allocation in my portfolio that threatens my sleep at night comfort. If you get, and that's different number, Joe, for everybody else. Your number is probably different than my number. You're younger than I am. I'm married, I have kids, I've got other things that I'm thinking about when it comes to what would keep me up at night with my money. So when I get above 10%, I start to really get a little antsy, and that for some people, they'd be like, I don't care if I lose 10% of my capital, big deal. So everybody has to come up with their own number. Joe, do you have a number, Joe? Like do you have an allocation number that if you get above a certain allocation, you would be like, oh, geez, I really should cut some of that?
Not really, just because like relatively the amount of money I have invested is pretty small. So I think that like on Fidelity, which is the platform I use, they have like these analysis tools that kind of show like, okay, here's your portfolio risk. And it usually shows that my portfolio is like pretty risky on like their objective measure, just because I don't have a lot of cash to deploy, and so I'm not as well diversified as you are. Certainly, I mean, what do you own, like 80 to 100 stocks, something like that?
Yeah.
Yeah, I
I've
have.
pared back a couple, but I think I'm still right in that zone.
Yeah, I thought I had a count here on Active Trader Pro, but I don't. But it's like in the neighborhood of 18 to 25 at any particular time.
Which
So
is probably what
naturally,
most people have. Yeah.
yeah, naturally, I'm gonna have some that are probably higher than an ordinary person would be able to tolerate. Like I know, for example, my two biggest holdings were Visa and MasterCard, and they were probably both like 18% the last time I checked. Doesn't really bother me because I know that they're both really stable stocks. So I think in the future, when when I've got a couple $100,000 in there, I'll think a lot differently, and I'll definitely naturally be more diversified as well. There are some stocks that I would love to own, and I don't have the capital to deploy right now. So for me, there isn't a particular number. Usually I have kind of a different strategy where I tend to trim my top holdings if I need to raise a little bit more cash to buy something. So if there's a stock that I'm like, oh, that's at a really good price, or oh, I think that they just reported great earnings or something like that, then I might go back and say like, oh, look here, I have let's find an example. I have 11 shares of this Fidelity software as a service ETF. Do I really need 11 shares? No. So I'll take 5 off the table cut my position in half. It's still a fairly significant position, and then I kind of seal in my profits as well, and go out and buy whatever's interesting to me at the time. So to answer your question, long story short, no, there isn't a particular number, but I expect that there will be a number in the future, and it'll probably be somewhere around 20%.
It's great that you mentioned that too, because it made me think of some other things too. There are other ways to raise cash, including, if you're investing in your account, like a 401k or 403b, where you're making regular dollar cost averaging contributions or whatever, and then you're allocating them. So sitting in cash until you allocate them, you can raise cash just by doing nothing. So, maybe saying to yourself, yeah, I'm not going to buy any more shares of the S&P 500 mutual fund or ETF. I'm going to just sort of sit on my hands for the next couple months and see if things start to fall. And then I'll start to contribute that money that way. So, there's a lot of different theories on ways to make money. And one of them is that, buy great stocks, let your winners run. Who cares if it ends up being 80% of your portfolio, right? You could do that as long as you had other money coming in that you can be setting aside to be able to use to take advantage of that next big opportunity. And I think that's really the value to me in being able to raise cash when it looks like the markets are getting a little overextended, is really in having the optionality to take advantage of the leaders that emerge the next time markets go up, because it's not always the same leaders on the way out as they were on the way in.
Right.
And I think that, just to go back to my 2020 experience, if I look at my best performers from March 2020 to December 2020, Carvana wasn't in my portfolio at the end of 2019. That was up 1,000% for me. Fulgent Genetics wasn't in my portfolio at the end of 2019. That was up 1,000% to me, right? I had Tesla, but I added to Tesla, and that ended up being a huge winner for me as well. So, for me, it gives you the optionality to take advantage whatever the next leaders are coming out of that basket. So I think that's where the value is, or can come from, in maybe doing some massaging of your portfolio at these different points in time to have cash available to be able to take advantage of that opportunity.
Right. And again, that cash position is going to vary for each individual. But just to get an idea, because I'm guessing there are some people out there who are kind of curious, what's the maximum amount of as a percentage of your portfolio, what's your maximum cash position you would ever hold at any point in time?
I don't want to say a number that I would regret later on, because theoretically I'm flexible enough to say to myself, I'll go 100% cash if I see the end of the world coming.
Right, right.
I mean, so the most that I would ever hold would be 100%, right? I would say that if you just look at recent history, so since the Great Recession coming out of the 2009 period, the most that I've ever held would probably be a little over between 30 and 40%. I was probably close to that amount in January and February by the time I finished raising cash. More recently, I did get up above 20. I was 24, 25% cash. I've since reduced that down. I'm now only about, if I'm doing the math in my head, I think I'm probably around 7 or 8% cash. Some of that came from selling low conviction names. Some of that came from pairing, and some of it came from I use a SEP IRA, and I contributed more money for my SEP IRA for tax purposes. So it can, like I said, the cash could come from different places, and I'm contributing. I'm watching now because we go into April to see, April's historically, we talked about this on the podcast with Jeffrey Hirsch, Stock Traders Almanac. We talked about weakness at the end of March, turning into strength in April. Be interesting to see how we go forward here in April, but I am continuing to model that. So I am committing more cash that I had raised, and I'll probably be mostly invested by the first couple days of April. That's kind of where I'm sitting right now. And then, so as a general rule of thumb, though, Maybe keep 5 to 10% cash for that next best idea that you have, and then you can increase it or decrease it, at these different points in time.